Welcome, everyone. Tuesday, January 10, New Year. Not much has changed except we turned the calendar. As has become our custom, I'll start off with 3 dates in history that I selected. First one I didn't even know, and shows you what an ignoramus I am. In 1861, Florida seceded from the Union. I never even thought about that. I never knew if they were in the Union, Confederate, whatever. Anyway, Florida in 1861 seceded from the Union. They joined the Confederacy. Who would have thunk? 1920, the League of Nations was formed in Geneva, precursor to the United Nations. And in case you're wondering why I led in with the David Bowie song, it's because in 2016, 6 years ago, David Bowie passed away. I was into David Bowie. I thought he was terrific. So anyway, those are your 3 dates in history. So many of you have been asking for a while if we could get an expert on financials into this space. We've had a lot of wonderful expert speakers on a variety of topics. I guess it was proponents of energy speakers, but we never had a financials guru. Well, today your prayers are going to be answered. Charlie Peabody, many of you may not know who he is, especially some of the younger investors out there. He's been around as long as I have. He started his career, I believe, it was in 1981. He's been on the street since 1981. He was II ranked banks analyst for Kidder Peabody, and also was a leading analyst at other bulge bracket firms in the street: Drexel, Merrill, UBS. I may have missed some, but he's been around, and he knows where all the bodies lie. And so if you've got some impolite questions you want to ask about financials, and I forgot to mention, he heads up Portalis Partners, which is a specialist firm. I don't mean specialist and stock exchange specialist, but they specialize in financials. And so if there are questions which you might deem to be impolite to ask your friendly bulge bracket banks analyst, have no fear. Charlie is here. So financials have been, front and center a lot of things. There's an old adage that if financials aren't acting well, it's hard for the market to do well. Of late, they've been acting okay, and I think Charlie actually, in the short run, is somewhat positively disposed towards the financials. But I'm not going to steal his thunder. So, in any event, Charlie, please unmute yourself. Great that you made it here.
Thank you.
Can you hear us? Okay.
I can. Can you hear me?
Yeah, you're perfect. You're perfect. So, welcome to Twitter Spaces. I know it's your first time. It's your coming out party, as it were. Don't worry, we're going to be nice to you. And by the way, I'm just warning you, I see some of the characters we have in the room right now. Got some really sharp cookies here. So I think you're going to enjoy this. I think we're all going to learn a lot. So thank you for being willing to spend the time with us. Charlie has an error, by the way. So we're going to try and keep it tight. So let's get into it. So Charlie, there are a lot of moving parts right now in the financial landscape. Markets gyrating all over the place, rates gyrating all over the place. We saw the most rapid increase in interest rates, I don't know, maybe ever or whatever. And there's a lot of reset going on. I mean, the housing market, people can't afford to move now because mortgages have gone from, mortgage rates have doubled. Companies with floating rate debt are going to have a lot of problems. There's the old saw about, steepening yield curve is good for banks, et cetera, et cetera. But life is not always so simple. So, Charlie, they're really here to you speak. I want to trigger you. What are sort of, of late, the last couple of weeks, what are sort of top of mind topics? What are the things you're focused on, you're concerned about? What's got your attention right now, Charlie?
Sure. Well, listen, first of all, thanks, George, for hosting this. I appreciate it. And I'm hoping I'll learn as much from the kind of questions that are being asked as much wisdom as I can attempt to impart on the subject matter here. But obviously, the big elephant in the room is when does the recession or credit cycle from a bank point of view, when does the credit cycle start to hit? And our position, basically going back to January of 2022, was that we would not have a recession in 2022 and probably not until the middle of 23. And we continue on that course. But the fact that there's a recession looming out there has caused most institutional portfolio managers to shun the banks, saying, why would I want to buy one ahead of the credit cycle? Things are only going to get worse. And well, I agree that banks typically don't find a secular bottom until the trough of a recession. We've been trying to play the squiggles along the way. And so we started off 2022 very negative on the banks, calling for about a 30% correction into the spring, and then thought they would bottom during the summer and then end the year with a 30 or 40% rally. That rally did happen in October, November, got truncated in December, and we think there's still more to go into the spring of this year. So we're starting off this year with a constructive stance on the banks. But we think they'll end on a sour note because we do believe by the second half of the year, the credit cycle as it relates to the bank fundamentals will start to emerge. So yes, we're being cute by staying constructive here. But we do think that people have over anticipated the credit cycle, and we just don't see the negatives on the credit front being as significant for banks just yet. And in the meantime, what we've been focused on is what we call PPNR, pre-tax, pre-provision net revenues. And we found that banks have a much stronger correlation with that variable. It's basically total revenues minus operating expenses. And that PPNR has been accelerating year over year for the banking industry. And it will get even stronger here in the fourth quarter. So we have PPNR rising 16% year over year. So what that PPNR tells you is how much earnings power do the banks have to absorb the credit costs that are likely to emerge over the next 12 to 24 months. And we don't think credit costs will peak in their rise until sometime in 2024. So we are anticipating at least a doubling of charge-offs and loan losses going into 2024 and staying high for about 2 years. But even with that kind of forecast, we still think banks can generate pretty good earnings. And even this year, we have earnings growing this year for the banking industry. So the underlying fundamentals, this time around versus 08, 09, when we were very, very bearish, is much more constructive. The banks have done a good job in their risk management, rebuilding their balance sheets, rebuilding their capital, et cetera. If there is a more serious recession rather than a mild recession, and we're in the mild recession camp at the moment, if there's a more serious recession, then estimates are way too high. We are going to see estimate cuts at some point this year, but we don't think we'll see the balance sheet impairments that have characterized prior cycles, and that's a big difference because while we could have an earnings recession for the banking industry, we don't think we'll have a balance sheet recession. And so when we come to the other side of the recession, the banks this time around will have their capital intact and will be able to go on the offensive day one. And that's a big difference versus what we've seen in the past 3 cycles. So we think the banks could emerge in the other side of a recession with their capital intact on the offensive and earning, mid-teen to high-teen types of ROTCEs. So from a longer-term perspective, we're actually very constructive on the banks. from a very short-term perspective, we're constructive. On an intermediate-term basis, we're cautious. So, sorry, George, I apologize for talking too long.
No. That's extremely helpful for setting the room, and you put a lot out there. So you and I have known each other a long while, and I want this conversation to kind of run along the lines we would normally be if we were sitting in a conference room together. So let's stay with that. So I'm known as being leaning bearish, if not perma bear or whatever. And listening to you talk, I must confess, it sounds like a pretty benign environment that you're discussing. Yes, credit quality will deteriorate as we get into a recession, but the way you're describing it sounds like they're pretty, in terms of their capital situation and the extent to which they're leveraged or not leveraged in comparison to the last cycle, they're in pretty reasonable shape, are they not?
They are. And because of that, they're probably, many of the banks, postponed or suspended their share buyback programs last year. When they start reporting earnings on Friday of this week, you're going to see organizations like JP Morgan and Wells Fargo, restart their buyback programs. And those are going to be, multi-billion-dollar buyback programs, $9, $10 billion, $12 billion types of buyback programs. And, Wells Fargo, we think, can retire 5% of their shares this year. So the capital, is getting back to the point of being excessive. And in the interim, their earnings power is improving, which allows them to rebuild their capital as they, deplete it through share buybacks and dividend increases.
So, Charlie, you always have one of the things I always liked about our dialogues over the year was you always had you were very macro aware, very macro, big macro approach to looking at the financials. And for all the macro tourists out there, I guess I'll self-identify, and there are many in the room. If you read one more research report or zero hedge article about, the yield curve is the most inverted it's ever been, blah, 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 and every time you get an inverted yield curve, you get a recession. Okay. So we all know that, and so if we get the recession, it'll be the most advertised recession ever, perhaps. And in fact, recent economic data, looking at the Atlanta Fed nowcast data for fourth quarter 22, showed things actually improving.
Without doubt.
And so I think it was Bob Farrell who once said, when everyone is expecting one thing, it's not worth investing in that because either it's not going to happen or it'll happen, but it's already discounted. So I'm kind of arguing against myself here. I'm just sort of meandering. It's a rant, and maybe I'll trigger you here somehow. So how do you think about the fact we've got this inverted yield curve, yet given how far the Fed was behind the curve, rates were incredibly stimulative. And then I'll put some other logs on the fire. You look at and shoot me down because I'm a hack. The real debt accumulation this cycle, it's been the sovereigns that have gone crazy with piling up debt. And I'm not saying balance sheets are wonderful, but I know, for instance, look at consumer debt ability to service debts. That ratio is extremely high right now. Those ratios are reasonably healthy. Corporate ones are reasonably healthy. The real debt accumulation problem has been in the sovereign sector. So what does that mean for the banks? Does that mean we have a less bad credit cycle, that the risk is really with the sovereigns and the governments? Or so I guess the fact that the debt ratios aren't so bad, and the fact that we've got an inverted yield curve, and the fact that only up until recently were real rates. They're not even real rates, aren't it? You can argue about it, but we really haven't had significant positive real rates for any sustainable period of time. So you put that up in the blender and shake it all up. What does that mean to you? How does that speak to you?
Yeah, don't get me wrong, George. We're going to have a credit cycle, and it's going to be ugly. I just think there are two things. One, the banking system is much more prepared this time around, and their risk management practices have been much more solid this time around. But more than that is the problems are really going to be surfaced in a big way outside the banking system, and we're already starting to see that. So I'm pessimistic in the sense that I do think we're going to have a very rough credit cycle. I'm optimistic in the sense I think banks are much better positioned to absorb that. The other thing is, if you were to read our, outlook for 23 piece, which we published in December, we were saying we're going to start off the year with a, maybe 15, 20% rally through the spring. But then it's going to be sell in May and go away. And you're not going to want to even look at potentially buying these things until sometime deep into the fourth quarter at the earliest, on the assumption that credit costs will peak sometime in 2024. So we're not being Pollyannish in terms of the credit cycle. But let me just throw out some numbers. For example, okay, so JP Morgan, which is a major credit card lender, is going to have credit card charge-offs this year somewhere around 1.5% on the full year. And next year, they're projecting 2.6%. So it's a big jump. And this is a dilemma for me, but I'll come back to that. It's a big jump in terms of the dollar amount that charge-offs are going to go. But relative to history, a 2.6% charge-off ratio on a credit card portfolio is very low. You would think at least 300, 400 basis points, which is kind of where I'm building my model for 2024. And that's the dilemma, is the marketplace going to worry about the rate of change, from 1.5 to 2.6, or are they going to worry about the level, 2.6 being very low by historical standards? And if it's 2.6, then the PPNR, or the pre-tax, pre-provision net revenues, are going to be so strong that they're going to be able to absorb that without significant impairment to earnings.
Yeah, Charlie, what's driving the expansion in PPNR? Is it net interest margins expanding? Is it loan volumes? What is driving that growth?
At the moment, it's both. And that's the big worry. I mean, if there are three things that you hear in terms of institutional portfolio managers pushing back on a constructive, I mean, the overall one is why buy them ahead of a recession? And I understand that. From a secular long-term point of view, I agree. But the other is that we're going to see peak NII, net interest income, which is what we call top-line revenues or net interest income. We're going to see that peak here in the fourth quarter or first quarter, and that the loan growth that they've enjoyed over 2022 is going to slow as we move towards a recession, and that the margins, the net interest margins, are going to start contracting. And, we're not, disagreeing with the ultimate direction on those two items, but we think that margins are going to hold up longer than anticipated, and that NII is going to keep accelerating through at least April, probably July. So that gives you a lot of earnings power to absorb those rising credit costs that are inevitable in latter part of 23-24.
Charlie, as rates have gone up quite sharply over the course of the last 12 months, has that not had a really beneficial impact on net interest margins in the sense that, they're jacking up, they're not raising deposit rates as much as their lending rates? What is it, or I don't put words in your mouth, what is the impact of the substantial increase in rates and the inversion of the yield curve? What does that effect had on bank net interest margins?
Yeah, so margins have expanded quite aggressively this year, and that's the other bear case argument, is that margins are going to peak somewhere here in first quarter of 2023 as what you refer to deposit betas pick up. And as deposit betas do pick up, they're right now what we call cumulative deposit betas around 30%. And they're going to probably, peak out somewhere in the 40, 50%. And so what it basically means, to explain that, what deposit betas basically mean is how rapidly do your deposit costs go up versus your asset yields, if you will, and in terms of adjusting to the rising rate environment. And deposit costs historically lag the rise in loan yields or other asset yields. And so your margins expand during that period. Now the feeling is deposit costs are going to play catch up with that rise in asset yields, and therefore your margins are going to come under pressure. And the reason we're saying maybe not so fast is because there's still, despite QT, the banking system still has decent liquidity and deposit flows. There are two elements out there that this may get a little arcane, George, so cut me off if I'm getting too much into the weeds. But there are two possible elements out there that could extend that deposit flow in the banking system. The first that I've written a lot about since November is what we call a potential treasury buyback. And in a treasury buyback, the treasury would issue fewer and fewer long-term or coupon securities and more T-bills. And if you understand the Fed's balance sheet, there are two line items you want to watch on the liability side. What's happening to reverse repo balances and what's happening to excess reserves in the banking system. And so far, what we've seen during QT is excess reserves in the banking system have been coming down by $500 billion, but reverse repos have been growing very rapidly. The big owner of the reverse repo facility are the money market funds, because there's been a dearth of T-bills up until recently. So they park their excess liquidity in this reverse repo facility where they can get a pretty good yield. On the excess reserve on the Fed's balance sheet, that reflects the liquidity in the banking system. That's been coming down because of QT. If the Treasury decides to do a Treasury buyback, they're going to issue excess T-bills, which drains the reverse repo facility that the money market funds have their excess liquidity parked in. And they're going to buy back coupon securities. And when they buy back those coupon securities, that creates a deposit for whoever sold that coupon back to the Treasury. And that deposit gets obviously put into the banking system. So it could extend the liquidity or deposit flows of the banking system through this Treasury buyback. And if you listen to the TBAC committee, the Treasury Borrowing Advisory Committee, and the back and forth between that committee, which is basically the Wall Street, primary dealers, and the Treasury, you're going to see that there's significant capacity to issue T-bills and buy back coupons. And if I've estimated as much as $1 trillion, because what the Treasury has publicly said is they want T-bills to represent about 15 to 20% of total marketable securities. And right now we're at the lower end of that range, around 16%. So they have plenty of capacity to issue more T-bills. So that's one reason why I think that the NIMs, net interest margins, could remain higher for longer, because the liquidity in the banking system could be goosed by a Treasury buyback. The other thing that's come up more recently is the debt ceiling, limitations. And that's right now, if you looked at the T-bill auctions this week, it's forcing the banking system to issue much more T-bills than anyone anticipated. And anytime you think about T-bills being issued, you have to think, who is the main buyer of those? And the main buyer of those are the money market funds. So you should be starting to drain the reverse repo facility. That should lead to deposits into the banking system. Sorry, I apologize for being long-winded.
You've made it very clear. We do have some smart financial cookies in the room, and I want to get them here to get a Q&A going. So I don't know if KFAB, you want to jump in, or any of the others here, who, please have at it, raise your hand. Let's move on. Other topics, and I'm sorry if I'm a little bit off base here, but something certainly which features prominently in the headlines is private equity. A lot of leveraging up by the valuations that were paid to take out companies, increasing amounts of leverage, et cetera, et cetera. And I know you don't specifically follow those companies, but do you have any perspective on the potential risk that might pose? Is it a risk? Is it large enough to be a problem? And I don't know if Brent thinks that instead, but
let me start on this, and then my partner Brent can clean up my mess. We are very negative on the private credit, private equity market. And we think that it's been a very slow process on their part of recognizing the impairments. And you can see it from the letters that the quarterly letters that are put out by some of these investors. They're marking their public portfolios down last year by 30, 40%, and they're marking their private portfolios down by 10 or 20%. There's a huge lag in the recognition of the impairment in that space. Now, there probably will be a catch up in these fourth quarter earnings, and Instacart is a good example. I think what Instacart did another round and was devalued by 20% to $10 billion or something like that. And then there are games being played, such as we saw with the BREIT funding. Brent, I don't know if you want to pick it up from there and talk about that or some of the other issues. But yeah, we're very bearish on the private equity guys.
Charlie, let me just back up what you said.
Just so everyone knows who Brent is. I've known Brent. Oh my God, 30 years now, Brent, thereabouts.
Oh boy.
Brent's a long. I first met Brent when I think we were yes, if I'm not mistaken. Brent eats, breathes, and consumes financials. So Brent, have at it.
Thanks, George and Charlie. So just some numbers. Venture capital alone has raised $400 billion since 2020. So that's 90 billion, and then 150 billion, 150 billion in the last 3 years. It's not like this is new ideas chasing money. This is money chasing investment ideas. So it's money that's created by the Fed. The other thing, private credit markets, private equity and credit total over $1 trillion in each of the last 5 years. All of this money is about to collide with the end of the business cycle. It's pure and simple. It's just staring you in the face. So to that end, these things are opaque, unregulated, and private by definition. So all these transactions that Charlie said are taking place in terms of the marks, they're lagging. They're not taking place, and they're hidden. They're obfuscated. As I said, they're opaque, unregulated, and private. So there's a lot of catch up here. Now with BREIT, for example, BREIT was essentially a gated a fund of Blackstone with I think order of magnitude, $60 billion in it, and they had to prevent outflows. So on their most recent fund, they had to invite University of California in with a $4 billion commitment locked up over 5 years with a double-digit guaranteed coupon, 11% guaranteed coupon by BREIT to University of California. So the last time I heard something like that happening was with Bernie Madoff and his 11%, year in, year out return.
Yeah, Brent, I was going to say, what type of what's running? Leading question, bad joke. I'm here. What's the mindset of an investor? What does it say about the investor's mindset if he's demanding a guaranteed return? And what does it say about the financial position of the entity that's offering that return? I mean, is this a situation where desperate times require desperate things? Like this, come on, this is outrageous.
Well, more curiously, why did Blackstone go up? The stock could go up on this news because the investors are heaving a sigh of relief that they got away with another one. I mean, so the answer is I don't know, except they're unregulated and opaque. And even if they were regulated, what would the SEC do anyway?
George, let me just add one last thing. There are two variables to a credit cycle development. The first is when liquidity is withdrawn, you see a devaluation in the asset values. But then when the actual credit default cycle hits, you see a reduction in the cash flows. And what we've had so far is just the liquidity events. And to the extent that some of these private equity companies had a lot of locked in funds, they've been able to manage that part relatively well. By the middle of this year is my belief that we're going to start to see the cash flows and the credit defaults really impinge on their valuations. So yeah, I'd like to be short the private, equity guys.
Got it. So one other question, then we're going to bring some of the audience in. I know when you and I were speaking earlier today, Charlie, you were mentioning, I guess, what Jeffries had the numbers out yesterday.
They did. Yeah.
Talk a little bit about what was in the Jeffries numbers and how are you thinking about investment banks? I mean, Goldman announced another layoff, et cetera, et cetera. So what's going on with respect to investment banks and trading income and all that kind of stuff?
Sure. We use Jeffries as sort of a precursor as to what we're going to see for the big banks like Goldman Sachs and Morgan Stanley and JP Morgan, because Jeffries reports before the others because they have a fiscal year end of November. So Jeffries last night after the close reported 58% decline in net income on an 18% drop in revenues. And to no one's surprise, we expected it to be weak, and it was weak for all the obvious reasons that you would expect. In that it was investment banking revenues were down 53% year over year. That was partially offset by a 13% rise in trading. So, you did have some bright spots, particularly in fixed income trading, but you had a lot of weakness throughout the capital markets, mergers and acquisition, equity and debt underwriting, and even equity trading was not that strong. So, but the other part that we were just sort of alluding to is their merchant banking income was cut in half from third quarter to fourth quarter. And that's, where you're starting to see some of the pressure on these private equity positions. So, the numbers, as I said, probably are not out of whack with what we're expecting for Goldman and Morgan Stanley. But they do confirm that there is going to be weakness. What is different in terms of the mindset out there is the investment banking revenues are running today here in the fourth quarter below the 2019 levels. And there's a real strong belief out there that the 2019 levels are a floor. And therefore, there's this big rebound that's going to come in investment banking in 2023. And so some of the investors out there have been holding on to their Goldman Sachs and Morgan Stanleys on that thesis that they're going to get this big rebound in investment banking. I'm not one of those that believe that we're going to get a big rebound. I think it's going to be more delayed in coming and more muted in its rise. And then the other part of the equation is what's happening on the trading front. Fixed income trading, what we call FIC trading, fixed income, commodities, and currencies, that has been incredibly robust last year and the year before. And we think we're going to see double-digit, 20% plus declines in fixed income trading in 23 versus 22. The importance of that is trading revenues are multiples bigger than investment banking revenues. So if you get a 20% drop in fixed income trading next year, you got to have a 30 or 40% rise in investment banking just to stay even. And we just don't think we're going to see that kind of rise. So we think the whole capital markets are going to be a drag on revenues in 23.
Got it. Makes sense. Okay. So let's open it up to some of our friends here in the room. I see we've got some sharp cookies up here ready. We're going to go in order. Urs is going to go first, and then Rob, and then Bob Klein. Urs, welcome. Good to see you, my friend. What's up?
Thank you so much, George. Hi, Brett, and hi, Charlie. It has been a long time since we worked together at UBS and here in Switzerland. Hi. So my question I have is, what are your assumptions how long the Fed will keep rates as high as they are once they hit the peak? And, everybody's looking for that famous pivot. And if rates are staying up longer, what impact will it have in your assumptions?
Or is, I don't know if that's French for bear, but it sounds like you're a bear. Anyway, the assumption is that rates will remain, towards that 5% level through at least the third quarter of this year. We think the recession will force the Fed to start easing by year end 23. So we're not anticipating a pivot anytime in the first half of this year, but we think the pivot could come in the fourth quarter. And I'm also of the opinion that Powell has not grown a pair of balls at all. He's doing what is easy to do, but when the times get tough, he'll fold.
Or does that answer your question?
Yes, it did. And yes, actually, O stands for bear.
That's what I thought. Alors, tu parles français, alors.
I'm trying my best to get away from that image, though. Thank you so much.
And by the way, Charlie, one of these days we're going to do a space. We're just going to have Urs talk, because I think he was around in the stock market crash in 29. He's like seen everything. So he's like the wise old man of the forest. So it's always great when he shows up. All right, let's go now to Rob Isbitz and then Bob Klein. Rob, good to see you. What's up, my friend?
Hey, thanks a lot, George. Yeah, I guess I was born a Gemini. You definitely won't mistake me these days for a Taurus, if you know what I mean. Anyway, George, Charlie, Brett, thanks for doing this. George knows my bread and butter is things like technical sentiment. So my quick statement and my question is from that angle. 2008.
Sure.
the aftermath, distant memory unless you manage money through it, right? And if I recall, the public reaction to the financial system and the anger there was called Occupy Wall Street, not Occupy Main Street, right? They were pissed at Wall Street and the financial sector and the big boys, okay?
Mm-hmm.
So can you speak this time around, Charlie, or Brett, or both, to investor preparedness if we get another 20 to 30% drop in the stock market, which a lot of us on this call thinks inevitable, because since you're saying conditions for the financials are a lot better than in '08, will investors make that distinction this time around, or will they panic, kind of making financial stocks guilty by association in their history? Or are they more likely to just kind of close their eyes and hope, which is kind of what they've done about everything else the past few years? Thank you.
Yeah, no, they're going to cut and run. I mean, they always have. They, sell first and ask questions later. So yeah, listen. While I'm constructive between now and let's say April, I think these things could go. And let's say they go up 15 to 20% between now and April. They're going to go back and revisit at least their July lows of 2022. So I don't know what that is, a 40% drop or something like that. So yeah, you get me into May and I'm a seller of bank stocks because the credit cycle is coming and the portfolio managers, as you alluded to, are going to sell and ask questions later because they're, bank balance sheets, as much as I'm constructive on the risk management practices this cycle, bank balance sheets are black boxes. And there's a lot of things that we do not, as analysts that follow this industry very closely, do not see coming. I mean, we didn't see Archegos coming. There's going to be a lot of this counterparty risk with financial counterparties that levered up too much, and they're going to blow up. And and that gets back to Orz's question: the longer rates remain higher, the more detrimental that is to balance sheets and cash flows.
The question is, why haven't more people hit the dashboard already? Why aren't there more Archegos going on right now?
Sorry, go ahead.
Yep, Charlie. Just one more thing, just to follow up on this. I mean, kind of like the old Groucho Marx show. You bet your life. Okay, I think you just said the magic word, right? Counterparty risk. So isn't that sort of what leads to the bear tail on this whole thing? And I'm sorry, I think. Please, thank you for the time.
No, you're absolutely right. There is a counterparty risk out there that we have been writing about that we are not going to be able to see coming. And so if you look at the prime brokerage books of these big, brokers like Goldman and Morgan Stanley, they've been growing like weeds. Same with JP Morgan. Now I tend to have some respect for JP Morgan's risk management practices, although they did get caught by the London whale, if you recall. So they're not immune to these things. What all I'm trying to put in perspective is the earnings power, the capital capacity, and the lower risk profiles that we can identify of the balance sheets, which gives them, a higher probability of coming through this recession with their balance sheet intact. Maybe earnings do take a hit along the way, which is why I want to get out of the way at some point, this spring. But the balance sheet, I have a much higher degree of confidence is going to come through intact. The other credit issue that all these credit issues are out there, visible to the extent that we follow them, but they have long tails. Commercial real estate is something we're actually very bearish on. But if you had shorted commercial real estate, from a bank perspective back in the first half of 2022, you wouldn't have made a lot of money. The tail process, or the slow burning fuse, is taking a lot longer than I think anyone anticipated. Even QT, everyone talked about QT, how it was going to devastate the economy because of all this liquidity is coming out. For the first time, maybe Janet Yellen's been right. It's been like watching paint dry. It really has not been a huge event day one, put it that way. Right. It will be over time.
By the way, before we get to Bob, Charlie, I just want to follow up on the one point you made. So let's talk about commercial real estate a little bit. You look, I think there was that paper, I'm sure you saw it, and we all read the same stuff. There was that paper, I think it was in June of last year from NYU, where they guesstimated a number of, I think, $500 billion decline in the value of New York City commercial real estate. New York being the largest market. Who knows if it's, I mean, the aim here is not precision, it's accuracy. I mean, it's big. It's really big, all right? And you read all the stories, what's going on in San Francisco, this place, that place, and just the whole structural change in the way we work, where we play, where we live, et cetera, because I work from home and all of that. And so you look at REITs, and I don't think you guys follow REITs, but it's just like, to your point, I mean, there's no way in hell I would ever own any of those things, but trying to make money shorting those things, like there's easier, quicker ways to make a buck than that. But could you just drill down a little bit further? You said you're pretty bearish on the long-term outlook for commercial real estate, and obviously the collateral value there, et cetera, et cetera. I mean, do you think it's a sufficiently long tail that it's not going to put the banks in harm's way, immediately? Like they can sort of amortize this problem. Like, how do you think about commercial real estate?
Yeah, I mean, for the last 12 months, maybe even 15 months, banks have been trying to work down their commercial real estate exposure. So they know the issue is going to arise as a credit issue. Excuse me. And they've been trying to pare back their exposures. And I think private credit has stepped up in that gap. Brent, I forget who it was. Someone was bragging about how they've had plenty of opportunities to lend on properties because the banking system has, vacated the space. So,
Apollo.
It was Apollo. Okay. So yeah, and then there are games being played where some of these real estate lenders are not lenders, developers are buying out. Brent, I'll let you, since this is your bailiwick, I'll let you finish that story.
So Charlie, SL Green does One Vanderbilt, which is a beautiful building near Grand Central in Manhattan. And they crowed about getting Carlyle Group as a major tenant. But what they didn't tell was that they paid $100 million to buy out the lease from Brookfield that Carlyle had up the street. They paid, maybe it was $200 million, but they paid a large sum to lure Carlyle into that building so they could claim that they've got 90% leased up. Those are the types of games we're seeing. What kind of cash flow analysis is that? It's sort of the same thing that we saw with the B REIT. I want to mention one thing about Hudson Yards. You can see that from my apartment building in Chelsea. $25 billion project. It's got more office space than downtown Phoenix. And I actually can see see-through office buildings in Manhattan. But you're not seeing that in the headlines.
I guess they quote unquote forgot to put that
in. George, I may be skipping ahead here, but the way we see the credit cycle playing out is it's going to emerge first on the consumer front. And every cycle has something different about it. And every cycle, sometimes the consumer leads, sometimes the corporate leads. This cycle, we think the consumer will lead in terms of the credit deterioration. And then from a product perspective, we think the auto lending areas where the real shit's going to hit the fan today, tomorrow, the next quarter. It already is. I mean, you can see it. And it's because a lot of lenders were lending 150 to 160% LTV, loan to values. And now you're seeing, a 15% drop in used car values year over year in the Manheim Index. So a lot of that excessive loan to value in the auto industry in terms of a lending capacity is going to take big principal hits. The banks are really good at playing games of trying to postpone the recognition of that hit, but we're now coming to the point where they can't do it anymore. And I can go into all those strategies if you want. But so the auto industry, the auto lending part of the credit cycle is already hitting balance sheets right now. This will be followed up by the spring of this year, where the credit card losses will start to accelerate. The last thing to be hit on the consumer side, credit cards and personal loans will be starting to sour by the spring of this year. The last thing to be hit will be the residential real estate market. And quite honestly, from a principal loss perspective, I'm not as bearish about the banks underwriting, because contrary to what they did in 08, 09, they've tried to keep to near prime, prime, and super prime type of customers. And they've, underwritten on 70% LTVs, sometimes 80%. But so I think the principal loss, even though I think we're going to see deflation in housing prices, the principal loss that banks experience will be fairly muted, maybe 5-10 basis points. That transition by the spring in the second half will then transition to the corporate sector. So I'll leave it there.
That's great. That's great. Very helpful. Okay, let's go. My good friend Bob Klein. Bob, good to see you. Please unmute yourself. What's on your mind, Bob?
Thanks, George. Charlie and Brett, I know you guys are at heart credit guys, and I wanted to ask you if there's any glimmer of credit culture left at any of the major banks. Wells Fargo back in the 90s and early 2000s with Mike Laughlin, their chief credit officer, and he was just a real keeper of the flame of credit, the credit culture. And then you had Wachovia, which was just before they were purchased by, I think, First Union. They were just marvel at protecting credit and
Bob, you go way back, don't you?
Yeah, but so what I want to know now, is there anyone left? Is there any, or have they all been kind of chased out by the gunslingers that have been fueled by the Fed, Fed's easy money, so that it just made it so that it didn't pay. You couldn't hold out, watching credit and being careful, because the gunslingers made you look stupid for too long. And then I have a quick follow-up.
What was the, Brent, what was the bank where that was lending money right and left down in Texas during the oil boom, and they were drinking champagne out of cowboy boots?
Oh, that was,
Anyway.
Seafirst was one of them, but it was
it wasn't Seafirst.
Penn Central.
Penn
Square Bank.
And Continental Illinois and First City and all those guys. Anyway, so yes, the culture, believe it or not, has changed dramatically from when I first started looking at banks in the 80s. And I cut my teeth following the Texas banks. And by 1987, 88, most of the Texas banks were failing. So I learned firsthand how a bank fails. Bob, I'll tell you, I do think the culture has changed. I really do. I think, Dodd-Frank also forced it upon the banking industry as well. So I think, as we saw in the, pandemic, banks were part of the solution. They weren't part of the problem. They were out there, making their PPP loans to help support the economy. So I do think banks have some kind of religion, and it's going to take another generation for them to lose it again.
Let me make 3 quick points here, Charlie. One,
sure.
I would praise M&T Bank as holding a credit culture. Number 2, I would highlight JP Morgan as saying no to the Twitter loan and some of these hung loans you're seeing everyone else get hung up with, no pun intended. And third, I would argue that Wells Fargo, by virtue of the asset cap, not necessarily its own brilliance, is going to sidestep some of these major problems. That's it.
Hey, Brent, I'm going to try to put the cat amongst the pigeons. Just keep in mind this room is being recorded. So you said, you mentioned JP Morgan, they don't have hung loans. Which of the banks tend to be well hung, Brent?
I will tell you that the one that has been the one bank that has been spouting off the theme of responsible growth, and that's why they become the darling and the favorite, is Bank America. And yet Bank America has showed up in a lot of these hung loans as the lead. And what's interesting about that, this goes back to culture. About 3 or 4 or 5 years ago, There's a guy that led the corporate and investment bank at Bank of America by the name of Montag. And he got into a very visible spat with Moynihan, who's the chairman and CEO, about the fact that they were losing market share because Moynihan had put a cap on the balance sheet that the corporate investment bank could use, and it was capped at about 600 billion. Well, in 2019, 2020, Montag finally got his way, and Moynihan unleashed him, and that balance sheet ballooned to over 800 billion over the next year and a half, 2 years. So now you're starting to see that. You'll see that here in the fourth quarter. Bank of America is going to have, we're looking for 79 cents a share here in the fourth quarter. And they're going to have maybe $400, $500 million of write-downs in hung loans. So there is the marketing, gimmick of, we're all about responsible growth. And then there's reality. And the reality is they're going to have big write-downs here in the fourth quarter.
Got it. All right, we got Murder Zoe, another really sharp cookie. My friend Porter Collins. Porter,
I don't want to talk to Porter.
No, I want to interview Porter. Actually, we're gonna have Porter speak into space sometime because Porter can all teach us. I mean, Porter, not to embarrass you, always good to see you. What's on your mind, my friend?
Not too much. I'm super happy to talk to Charlie. He's one of my favorites, and so
you're kind, Porter.
So Charlie, just like Charlie, Vincent and I spend all day, every day trying to think about the credit cycle here, and where we are in the cycle, and history shows that, just like Brent was talking about, how because of the asset cap, Wells Fargo is not going to get into trouble, right? And so if you think about last cycle, PNC, because they had blew up previously, couldn't grow into the 06-07 cycle, more stupidity and luck than anything else. But it's whoever grows the fastest into the peak that always gets killed, right? And then if that's one layer, and then if you think about the second layer is whatever blew up, whatever asset class blew up before is probably not going to blow up again because the underwriting is better. And so trying to think about what asset class the underwriting wasn't as good. And so, while I think the banks are going to hold up better than the private credit, who grew much faster than the banks this cycle, how do you think about credit with that to think about? Because if you think about like a Silicon Valley, which obviously grew very fast, I think they doubled their loan book over the past couple years, and mostly into venture capital, corporate type lending. And then some of like First Republic obviously grew their loan book very, very quickly into COVID. How do you think about credit cycles? Because I happen to think that the commercial lending, with the covenant light lending, was something like, I think last cycle going in, it was like 30% covenant light, and this cycle it's something like 80 or 90% covenant light. So, how do you think about the cycle in that context?
Mm-hmm. But when you're talking about covenant light, you're talking about the debt part as opposed to the senior loan part, aren't you?
Yeah, but I mean, even the banks, even the bank loans, that they've waived a lot of covenants, or they've been forced to have covenant light lending because of the competition for loan growth.
Well, the loan growth, as you know, Porter, has been pretty anemic for much of the decade. It's only in the last 12 or 15 months that we've seen C&I loan growth start to accelerate outside of the PPP loans.
Yep.
So that's why I'm very bearish on the private credit, private equity portion, because they really did roll back a lot of the covenants on a lot of their lending. By and large, from what I hear and can see, I think the banks have been pretty disciplined in their senior loan lending facilities. Now, they've also partaken in the debt underwriting cycle and have been part of that process. So I don't want to say that they haven't done stupid things, but
they've been better in the moving business, which they should have been, right? They've been moving that type of stuff rather than holding it, which is good.
Yeah, but everyone's good at moving as long as there's liquidity. It's
Yes.
who gets caught when the punch bowl's withdrawn, and B of A has been caught. We think that Morgan Stanley will also take a $500 million hit on their Twitter loan this quarter. So yeah, we're now seeing who was a little excessive in their appetites. But listen, the credit cycle, what are we running, about 20 or 30 basis points of charge-offs right now for the industry, for the big banks. And I think that's going to go to 50, 55 over the, by the end of 50, 55 basis points of losses by the end of this year, and then higher in 24. And, that's, those are pretty those are what I would consider acceptable losses over a cycle. And they're not going to impair the capital of the banking system if that's where the losses, peak. So maybe, we get back to 400 basis points of losses on credit cards, but not 700, 800 basis points. And that's a big assumption on my part.
No, I would agree. I mean, like the dodgy credit was taken by mostly the non-banks. I mean, the Affirms, the Upstart. I mean, they took all Capital One's bad loans away from them.
Right.
So the Capital Ones of the world never really changed their underwriting. They've been disciplined. They'll go through a normal cycle as well. But I just think that this time it was a lot of the non-banks that took all the bad credit.
Yeah. Listen to those guys talk, by the way. Apollo, for example, they'll say, "Oh, we're senior in the capital stack. We're short duration, and and we know what we're doing. Unlike the stupid banks." Ha ha ha. The second thing is the CLOs. B of A has been booking CLOs and calling them commercial loans. CLOs where a lot of these problems are.
Yes.
Yeah, we call CLOs clowns, CLOWN, collateralized loan obligations worth nothing.
All right, so Charlie, I know we have a few more minutes. We're going to keep the room going, but I know you have a 1 hour hard stop. I have two follow-up questions I'd like to ask. One, and you may say, well, I don't follow them, which makes you even in a better position to speak on them because you don't have to be in print or whatever, but just your sort of visceral reaction, sort of pattern recognition. You've seen the movie before in different, the history rhymes, doesn't repeat. But do you have any thoughts about, Porter mentioned Silicon Valley Bank, which is on my radar screen. I have a position in it and I'm not long. Do you have any thoughts about, either Silicon Valley Bank or some of the crypto banks, Silvergate, Coinbase, not a bank, but it's a financial. And, and if you don't have an opinion you want to express, I'm sure Brent won't be restrained. So any thoughts, Charlie?
Yeah, let me start and then Brent can end with Silicon Valley because he's done some work on that. But yeah, we do watch the Fed's balance sheet every Thursday night. I'm an exciting guy. Every Thursday night, I pull down the Fed's balance sheet and dissect it. And I think it was in November, we started noticing fairly large borrowings from the discount window. I think it got as high as 10 billion. And we wrote at that time that, that first of all, that level of borrowing was not a major bank type borrowing. It was clearly a mid-cap, small-cap regional bank. And it was also the time, of the crypto crisis development. And so we had highlighted, the borrowing and, attributed to either a mid or small cap bank and the product being a crypto event. And so now we read about Silvergate, having had, liquidity problems in the fourth quarter. And then if you looked at the Fed releases of last week, you would see they put out an advisory to the banking system about being careful of what you do in the crypto space because it could lead to deposit runs. And the Fed's always good at putting things out after the fact. So we know that there's been a liquidity crisis for anybody who has been, attached to the crypto space. And we do believe there's going to be a liquidity crisis for anybody who's been attached to the private credit, private equity space. So with that, I'll turn it over to Brent on Silicon Valley.
Okay, I'll just say that Silicon Valley has a pro-cyclical, free money business model, and that is reversing at the moment. So not surprising, his stock is a quarter of what it was. And so it's a dangerous short here, but this company is unraveling. And you're seeing it top line revenue. Okay, they are liability sensitive, and they get really hurt when rates go up. Second, they get disintermediated because their deposit base, which is normally free, zero interest rate based operational deposits for these venture capital Silicon Valley type companies, that deposit base gets pressured as interest rates go higher. And the third thing is that the sweep accounts that they claim are non-balance sheet deposits, I'm not sure they're going to be there when they really need them. So the bread and butter of this company's business, top line revenue, is under pressure. The second thing is they take a lot of warrants as part of their payments, and the value of that warrants has been hurt in the past 12 months. The third thing is that their bond portfolio is vastly underwater, and it's all held to maturity, which means they don't have to record it in TBV, which means it comes in a footnote in their balance sheet that their tangible book value is about a third of what they reported. It's about a third of what they reported. So I'll leave it at that. But one last thing to remember is this company will start with a cradle company that's being venture financed, and then they'll provide some working capital loans, and then as the company grows through its birth to death process, they hire employees, they need a pension plan, they need cash management. So Silicon Valley banks them all the way through the cycle as they grow through their growth curve. But that, as the IPO cycle stops, this conveyor belt stops mid-track. And all of a sudden, it's not venture capital anymore, it's venture debt. And all of a sudden, Silicon Valley is lending more to these companies, and all of a sudden, those loans start to go bad. And that conveyor belt just starts to empty into a giant pile of trash. So that's what's happening with Silicon Valley Bank.
Other than that, everything's fine. Okay, so listen, Charlie, we're going to keep the room going. And Brent, maybe you can stay around, but Charlie, I know you have a hard stop. I want to thank you for this. This is awesome. Quite a lot. It's great. And for anyone who's interested in research from Portales, please reach out to Brent. You can DM him, or you can email him. It's bbe@portalespartnersllc.com. I'm not going to give out his phone number because, I don't know, he's a bachelor, I think, so whatever. But at any rate,
maybe you should be giving out my phone number.
There you go. You gonna put one of those fake pics up there, Brent? So anyway, please DM Brent if you want to learn more about what Portales does. Charlie, I salute you. I thank you. I hope this hasn't been too tough for you. And I hope you'll consider coming back again, Charlie. If you left us. All right. Brent, are you there?
I'm here.
Okay. So let's talk a little bit. Let's get a little bit more granular. If you want to name names, that's fine. But just everyone know that this is not, do your own work. This is not investment recommendations. But Brent, to the extent you want to talk about, I don't know if you want to get into particular names or just sort of conceptually, let's sort of drill down a little bit further what Charlie was talking about. So it sounds like you guys don't like banks that are too tied to trading revenue. Is that fair? I mean, you're looking for weakness in that area going forward.
So capital markets would be the catch term, and trading is actually holding up nicely in the secondary markets because of all the stuff that's out there to trade. The second thing is it's investment banking and IPOs that are really, it's moribund. And that's the 60% decline in revenues that Jefferies was reporting last night. That's happening. The question is, how long will it stay moribund? And we're very bearish on the outlook for 2023, while everyone seems to be calling back for the animal spirits to return. I would also point out that in the case of Goldman Sachs, they've got a lot of venture capital, private equity assets to address. And with regards to Morgan Stanley, I would just say that they've been fairly aggressive in the hung loan space. We would be avoiding both of those names.
Got it. And the sort of just traditional blocking and tackling banking without getting terribly creative, that's based on what Charlie and yourself were saying. It sounds like it's in pretty okay shape, no?
Basic banking is, if you think about it, your asset yields have just gone up dramatically and your costs have gone up very nominally. So your spreads are at gargantuan levels. Wells Fargo is going to be up 20% this year for NII. They're going to be up 20% in 2023 as well. I'm sorry. In 2022, they're going to show 20% back-to-back increases in NII. And that's very impressive. So Wells Fargo, we like on the long side. PNC, we like on the long side. And Truist, we like on the long side. To a lesser extent, JP Morgan. We have a kind eye towards Citi, which is an interesting disaggregation story. And we kind of like CFG here, Citizens Financial, kind of in the plain vanilla regional bank that's complicating itself in an interesting fashion.
So Brent, let me ask you, given that I think bank earnings season starts this Friday, if I'm not mistaken, and that the recession is later rather than sooner, but the NNPR or NPPR, whatever you call that thing, is accelerating. Do you think on balance the takeaway from the earnings calls that are starting on Friday will be positive?
And the answer is yes. And in January, everyone can be optimistic. And yeah, Jamie Dimon will grouse about the higher interest rates, et cetera. But at the same time, as Charlie mentioned, he might be announcing a buyback. So Wells Fargo, I think, will be offering further guidance on its strong NII growth for the coming year. They took a major whack with a $3.5 billion hit, settling with the CFPB. But that's moving the pig through the python of regulatory nightmare that they've been going through.
Got it.
And,
let me go on a completely. Sorry, go ahead.
Well, PNC we'd add in there as more of a plain vanilla type bank that we like.
Got it. Let me go in a slightly different direction. By the way, if anyone has a question, please raise your hand. Brent is quite well spoken and experienced, so it's great that he's in the room as well. So Brent, could you talk just a little about crypto? And we try not to talk about crypto in these rooms, but I want to ask a specific question about crypto, and that is, the regulators have, for whatever the reasons, I mean, the snail's pace at which they've been approving things is actually quite good because it's kept the crypto disease out of the main banking system. The on and off ramps have not been available. And so, I look at crypto and the wealth destruction that's occurred. It's nothing. It's really minimal. I mean, Bitcoin, roughly speaking, with 21 million coins outstanding at $17,000 a coin, you're talking onwards of a $400 billion market cap. Maybe at the peak that was a quadruple, $1.6 billion. So, $1.6 billion to 400 billion, $1.2 billion market decline, like big deal. I mean, the wealth destruction in the price declines of Meta and Google, easily eclipse that. So it's not a systemic problem. The banking system doesn't, for regulatory reasons, not have exposure to it. So, I mean, I just think they should let the whole thing twist in the wind and burn down. But my question here is not to rail against crypto. More from your travels when you talk to the banks as you see it and you think about the regulators, how do you think this thing plays out? You think, I mean, when you talk to senior bank guys, they're just like, they think it's funny money, nothing to do with it, or how do you think about crypto as a veteran financial analyst, Brent?
So the quick answer is we don't worry about it. It's outside the banking system. So it's like an asset class, like Beanie Babies, or something else that go up in value and go down in value. We kind of laugh at it as being digital tulips, but because regulated insured deposits are not financing this asset, we don't care. It doesn't affect the banking system. Now, to the extent that a crypto asset is being used and monetized to buy a house, the wealth effect, benefited the economy on the way up. The wealth effect will, impinge it moderately on the way down, but it's not a systemic issue for us. So with regard to Silvergate, we never followed Silvergate, but their motto is all things crypto. So we'll leave it at that. I wouldn't touch it. It's probably too late to short it, but I would. Why would anyone want to acquire that as an acquiring institution, which is probably the end game at some point? So we're not. We kind of view it as a diversion. FTX blows up and no one seems to care, right?
Yeah, no, for sure. And by the way, because it is outside the banking system. By the way, we're going to have to put some quotes and some videos. Just awesome digital tulips, or I'm sure the crypto bro, like, they got your email address, dude. Like, they're not going to be happy. You describe these, like, you analogize them to compare it to Beanie Babies and digital tulips, but I digress. But to the extent that they remain outside the banking system, I mean, is that why, when you look at, for instance, when Fidelity tries to get approval for their coin, or JP Morgan, or whatever, the regulators are more than happy to just say no, because once you allow that on-ramp, off-ramp, and like you say, you have deposit-taking institutions, their capital starts getting exposed to this stuff, then it becomes a real hornet's nest. So isn't this almost by design, the way the regulators are they're dragging their feet, they're saying no? I mean, it's what I would do if I were them, in the absence of serious regulation for crypto entities. Do you have any thoughts about that?
I think for any regulator to take on crypto as a career mission is just a fool's errand. I mean, why would you want to do that you're sticking your neck out for something you don't understand? So that's from the regulatory standpoint. From a banking standpoint, you would want to, you're drooling at all the money that's chasing this fictitious asset. But the bankers, I'm not really sure how to answer that question.
All right, let's go to something else more tangible. We haven't talked about any things international. I know you guys don't follow foreign banks, but Brent, am I right? You used to follow Latin American banks back in the days.
Yeah.
That's right. Okay, fine. So let's talk a little about foreign banks, be it Latin American banks, Chinese banks, Japanese banks, European banks. I mean, oh my God. I mean, it's probably just no more than the fact that German bund yields are going up, but even European banks are going up. So do you have any thoughts about foreign banks in any of these geographies relative to U.S. banks?
So Charlie, he's more favorably disposed towards the European banks than I've been, but I don't really feel comfortable going into that area. And then with regard to Latin America, I just want to remind you, it's the last century that I covered the Latin banks. So, I look at what's happening in Brazil, and I'm horrified. Traditionally, the entire continent of Latin America has been a commodity-based play on China, and the commodities are responding, but the Latin banks are not. So there's some kind of disconnect there, and it might have to do with the wave of populism that's hitting Latin America harder than it's even hitting up in the United States. So I'm a little gun shy now, even in Latin America, on a commodity-based boom that we've seen. Brazilian banks are not acting well at all.
And Brent, isn't it fair to say that going through the last cycle, the U.S. banks, there were so many initiatives were taken to try to strengthen the capital structure and whatnot, that from a regulatory and capital standpoint, the U.S. banks really are far superior than a lot of these foreign banks?
Yeah, I would say straight out, I think JP Morgan's the most powerful bank on the planet. And it used to be, when you and I first met, George, the Swiss bank still had a tag end of respectability to them. I remember the UBS slogan, here today, here tomorrow. And, I'm not, then they got embarrassed towards the end of the turn of the century, and now they're just getting back on their feet. I guess the question, maybe we could come at it a different way.
So Brent, let me change gears. You mentioned UBS, here today, here tomorrow. What's your take on Debit Suisse? Does that just become a ward of the state?
Yeah, Credit Suisse is basically being liquidated in front of us, and I wish Michael Klein the best in terms of rebuilding First Boston. That'd be very exciting. Coming back to that capital question, though, the banks with 12% CET1 ratios. That's triple or quadruple the capital levels of the GFC, of the Great Financial Crisis. So that's number one. Number two, they've moved the end receptacle of all these assets that the banks have originated over the past 15 years have ended up in the hands of the private equity companies or non-banks. Those are the holders of the assets. So the banks, Dodd-Frank actually did a number on the banks and actually hemmed them in and required higher capital ratios that we never dreamed possible. So,
Brent, you there?
I'm here. Every measurement, the banks are much better than they were 15 years ago. The U.S. banks.
Amen. Amen. I was going to ask you one other question. I don't know if Dave Nikoski, if you're available, but it might be interesting to share your sort of technical analysis, looking at the charts, what you think of the banks. So if you got the bandwidth, Dave, if you're listening, I see you're down there. If you want to come on up, I'm sure I'd love to hear what you have to say. But before we go to Dave, one question. So Brent, you spoke before about how well capitalized the U.S. banks are now compared to past cycle, and one market where the housing situation is even more screwed up than the U.S. is Canada, and it's always been target of my affection. I want to go short the Canadian banks, but then I always get bummed out because I look at how well capitalized they are, and it's just I certainly would never own these things, but the loan to value ratio in these Canadian banks is like considerably lower than the U.S. banks, and they're better capitalized. And so I kind of don't wind up shorting them. I know many have. I think it's been working in the last few months. Do you have any thoughts on Canadian banks, Brent?
Charlie is always telling me, Brent, you got to short the Canadian banks at every opportunity. So one of the things he mentioned was the housing market, and the second thing he mentioned was the inflow and the lack of the inflow of Chinese money as it relates to the value of that housing.
100%.
So, but beyond that,
all right. Well, before we go to Dave, we have someone I think who does have an opinion on Canadian banks. Porter, back to you.
Well, I did this. I went to this Canadian housing conference I spoke about 4 or 5 years ago, and try to. This is about the same time that Home Capital blew up. There was some fun stuff to do around there, but the biggest thing about the capital levels look fine at Canadian banks, and they will be fine. But the bigger point is that it's this whole risk weighting shenanigans again. And so what the Canadians have is super low risk weightings on their mortgages. So it's more levered than it actually looks. So anyway, that's all I would say. If Canadian house prices do end up falling, 20-30%, I think there'd be more trouble than they lead on. But I've tried successfully and unsuccessfully to short Canadian banks. I would say it's sort of a waste of time. Shorting them. That's my
given that one has limited time, limited capital, Brent, Porter, my sense is like, if you could do Silicon Valley or Silvergate or Coinbase, like, why would you waste your time with Canadian banks?
Yeah, so I agree.
Yeah. All right. So we have Dave Nikoski, chartist extraordinaire, who follows the world, and so he can speak to not just U.S. financials, but some of the foreign financials. Dave, good to see you. What are you looking at? How do financials look to you, Dave?
Yeah, I'm not a fan of the regional banks, and they're not breaking down; they're just stagnant. I'm a technician by trade, but cover 43 markets from around the world and everything in the U.S. So, you have a what could be a bearish flag if we broke out and took out the recent lows on KRE. I'm bearish. I'm not bullish the banks here or bearish them. They're just kind of a neutral territory unless you break one way or the other. The strong areas within financials here in the U.S. is, majority of it is insurance. Obviously, your pawn shops have been doing well. Imagine that. When it comes to the foreign banks, I put a piece out a couple weeks ago and threw it up on Twitter on my profile. But, what's amazing to me is the European banks actually, as a group, are near 5-year relative strength highs versus our market. on an unweighted basis. So, they've gone from negative yields, in Europe.
All right, so Nicasio, you're going to play. I'm going to taunt. I'm going to taunt you.
I would expect that.
Okay, if you look at the price relative of European banks versus the U.S., okay,
yeah,
make that one chart, cover it up, and then I want you to take a chart of the price relative of bunds versus U.S. Treasuries. And so when you have, bund yields going from negative numbers to, where are they, 2% now or something like that? I mean,
yep.
That makes the rise in U.S. bond yields look like child's play. And the market tends to treat these European banks as just leverage plays on European rates. What would your thoughts? Agree, disagree, half agree, push back? Are you triggered?
Well, everything to me is relative, right? If you bought a house in Idaho and it goes down 40%, and you bought a house in Minnesota and it goes down 10%, I'll tell you where the safer place to buy is. It is relative, but it's amazing to me that we would even, see that type of behavior. It's at least providing a hiding spot such that if it is risk, the market certainly is pricing it wrong by pushing it up, to relative strength highs that we haven't seen in 5 years. And the longer the trend that's being broken, as a technician, I have to abide by, the price of.
Yeah, no, Dave, I hear what you're saying. I actually want to turn to Porter. I mean, the way I look at it, and Porter, I'll make the statement. You can agree, disagree, whatever. But I just think a lot of equity guys, they just trade those as proxies on what's happening to European bond prices. And, it's not the sort of thing where if you went to visit Deutsche Bank or Debit Suisse or UBS or whatever, you'd say, oh, this thing is great. I want to own this thing. I mean, these are trading sardines, not eating sardines. Porter, what would you say?
I totally agree. I mean, the biggest thing it was just think they were going from negative rates to positive rates. And to be fair, like I didn't play it because I kind of feel the same way, but it was a great trade and it might still work because you can't make money if there's negative yields, right? Nothing works. And so they're actually getting back to somewhat closer to reality of maybe these guys can earn some sort of cost of capital. So, they're trading at, they go from 60% a book to 80% a book, and that works, so that's sort of the way I think about it. But the reality of the last 5 years where we had negative sovereign yields is just batshit crazy. And so, we're moving from batshit crazy to maybe some sort of normalized world.
That's a great way of putting it.
Yeah, and I would put it that way too. I'm not, my view is not that you have to buy them, but just be cognizant of it. It's kind of like looking at the home builders and saying, they're at relative strength highs, 52-week relative strength highs across the board. But yet we all know there's a housing crisis. I, as a technician, have to show it and say, hey, I think there's, possibly another shoe to drop, but I can't ignore that that's what is happening.
Yeah, no, Dave,
be cognizant. So.
Yeah, Dave, 100% agree. It's that concept. I think it was Einstein who ever said it. The ability to have two opposite thoughts in your head. The technicals maybe on one side and the fundamentals on the other. I mean, I think it was Bank of America, Merrill Lynch. I'm sure Porter doesn't own this stock. I'm too polite to ask if he's short. It doesn't really matter. I know he would never own this stock. I look at Zillow. All right, so Bank of America came out with a upward revision, whatever. They took it from, I don't know, sell to neutral to buy, whatever the hell it was, and the stock's up 8% yesterday and up more today, right? They're just dead in the water. I mean, I get it trades as a proxy on rates and housing in turn trades as a proxy on rates. You have macro tourists that go in and out of these sectors, but just there's no freaking way I would ever own Zillow. Porter, you got any thoughts on that?
Totally agree. I mean, as a you have a huge universe of stocks to pick from. I don't know why you would want to play Zillow here. I mean, the housing market's dead for the next, call it 2 or 3 years, and same thing with the builders. Like, they look great on the charts, and Dr. Horton looks great, but I'd much rather wait 3 or 4 months and short the crap out of it, or maybe even a month.
Yeah.
I don't know whatever it is, but
And I think what's great about Dave's work. I mean, look, Dave's not going to buy every stock he has decent looking chart. He wants some of the fundamentals. Equally, when you and I are reported, we're like, oh shit, we're losing money or shorts, what's going on? And Dave can say, well, look at the freaking chart. It just went down, 1,000,000%. It could double and still be down, what's the definition of a stock that's down 80%? It's, something that was down 90 and then it doubled. Okay. So you have to have, I think, a holistic approach to these things. And that's why I think the work Dave does is so terrific. As I like to say, Dave, you can't dance with all the girls. Supporters point, why not buy a company that's got a good chart and a good fundamental story as opposed to some piece of crap, which is a complete trading sardine, where I promise you, the minute rates stop going up in Germany, Deutsche Bank will fall so fast it'll make your head spin.
And it was brought up about Latin America. Like Argentinian banks are on fire. Obviously with what's happening in Brazil. As well as I, looking at currency crosses, on foreign currencies. The Brazilian real has been, extraordinarily weak relative to other emerging market currencies, and that appears to start to be shifting based on what I'm seeing, that you're seeing some topping out patterns in the euro versus the real and the US dollar versus the real, where you're starting to get some weakness. Brazil had a great day today. I think I think everyone and their grandmother hates the place. I think, it's kind of like going back to the Asian contagion, the time you wanted to buy Korea, was when the tanks were rolling out in the street. And I feel like that's a possibility, especially with their commodity structure in Brazil. I just think that, the possibility that we're going to see higher commodity prices, I think is going to continue. Emerging markets, you had on a guest, not Michael Belkin, but another Michael Howell, and, he indicated that liquidity was increasing around the globe. And I think you are getting increased liquidity around the globe when foreign currencies are tightening. I've been a big proponent of the emerging market since October. Couldn't talk anyone into it. Couldn't get anyone to raise their hand. They're on fire, and it's not just China. I'm telling you, it's not just China. I have to go where, money flows are going, and it shows up in the charts.
100%, Dave.
Yeah.
Hey, let's
and
get
and George, and sometimes things don't make any sense at all, and sometimes they do. Right? In terms of Brazil, I think the Brazilian 10-year is 13.5%. The debt to GDP is half of what is in the United States, and they have better growth, and so Brazil's starting to work. That sort of makes sense to me, right? And the valuations have been beaten down, and they started hiking a lot, sooner than the U.S. Fed did. And so now that they're coming out of maybe coming out of the other side of this, that makes sense to me.
Supporter, see me, if we did an A/B test here, we got those Brazilian type of setups you're talking about on the one hand. This is just okay, and then we have, an electric car company with a $380 billion market cap with collapsing estimates and a disappearing backlog. Like, it's not even a question which one you'd be long versus short. Yeah.
Yeah, I mean, listen, as we figured out, the insanity can last longer than most of us have normal time frames of. So it's but
100%. Well, all right, let's go to Rob. You got your hand up. Rob, please speak up, my friend.
Yep, sure. Thanks. And I mean, I don't know if Dave Nikoski will admit to this also, but I'm an admitted chartaholic, so I couldn't help but go through a lot of this stuff. In fact, I went through the S&P 100 last night, thinking about this conversation, especially then focused in on the banks. And I was going through some of this stuff here. I'll just kind of give you my conclusions, either for Dave to comment on, for Brett to comment on, or for anybody to comment on, or just to move on. So, I look for patterns, and everything I do, it starts with fundamental and quantitative screening, but it all ends up with technicals. To me, it's kind of like NFL on Sunday. You can practice all week, but at the end of the day, the scoreboard on Sunday is what matters. That's the analogy I've used for years. So one of the names that I believe the folks brought up was Citizens, CFG. And I do see at least what I would call an intermediate term, hopeful bullish pattern. There's got some momentum, and let's call it a little bit discounted, which is always not bad. Technical value, I might call it. And you got it with CFG. You got it with things like PNC. BK, Bank of New York, KeyBank, US Bank Corp, Cincinnati Financial. What do those all have in common? I guess I would refer to them and also defer to a lot of the fundamental-oriented folks here. I would call them kind of second-tier banks, not demeaning their quality at all. In fact, they're not money center banks. They're not tiny, community banks. And that, to me, was the number one area. And I will also add that I absolutely hate, and maybe this is from, 12, 15 years ago, I hate the big banks. I avoid them like the plague. Yet I can't help but see that Citigroup and to some degree JP Morgan don't look bad. Last thing I'll say here, some of the other areas that look especially awful right now are things like Capital One and I guess the other one, symbol MTB, M&T Bank. So there's a mixed bag there. Even American Express, T. Rowe Price don't look bad. And I don't know, maybe somebody knows what MKTX is. I mean, I can read it as Market Access Holdings. That one looks like it's high risk, very high reward. And so to me, financials are a mixed bag right now, but those second tier banks, if you will, who probably don't have a lot of the problems that the big name money center, Occupy Wall Street banks have, there's something going on there, at least on a relative basis. So
Rob, I think you're spot on. Dave, when you look at the subsectors in financials and you listen to Rob, like how does that speak to you, Dave?
He's right on. I mean, I've got the same names. I go through the Russell 1000 and the Russell 2000 every week. I just got done going through it this morning.
We got a virtual
all day
yesterday, then, dude.
So MKTX, actually, I think I threw it out on my Twitter profile probably like last week before the big move. I'm pretty sure I tossed that one out there, but yeah, BK is one that I've got in here. So I do them I go through all the names, roll them out by sector. So I've got a lot of names in the bottom fishing candidate. KeyBank is in there, PB, CFG, FHB, FNF, SLM. I mean, and some other ones. US Bank Corp actually made the list in kind of the rolling over and getting close to the 200-day. But it's mostly brokers. The SIBO, BOKF is in positive inflection, so basing. Aon, Allstate. I put a piece out today on a lot of the insurance names. This is like my fourth time doing it. RE on the reinsurance side, HIG, Chubb, AJG, Aflac, are all in my positive trending, WRB and WLI on my larger cap side.
So let me interrupt for 1 second. Dave. This is for Dave or Porter or Rob or Brent. One of the listeners in the room, and I don't know this bank, they threw me a question. They said, can you ask about Signature Bank? There is risk around their crypto exposure. Is anybody on the stage?
Run.
Run.
I don't like that. Like that in a long time.
Go ahead, Dave.
I haven't liked that in a long time, and yes, it's in my definitely in a downtrend. I mean, not something I would ever look at until I see.
Porter, I think you've been triggered. What say you?
Well, it's pretty simple. They have $23 billion of crypto deposits. There's your answer right there.
Thank you, man. A few words presented to that comment.
George, is that a lot? No, just kidding. Of course, I got a spam call interruption, and I didn't hear the ticker. So
we were talking about Signature Bank.
Bank. Yes, I did. I sort of passed by that one. I was like, I don't want to talk about this one. Signature is SBNY. Okay. Yes, it's doing the dance of death. Technically.
Yeah. So now I'm going to throw a name in the pile which exemplifies. Again, this is do your own work. I'm involved in this name, not Signature Bank. I'm involved in this name. I'm not long. I wish I wasn't in that position the last couple of days. But Dave Nikoski, Coinbase. So this is one you got to split your head in half, because chart's one thing, but the fundamentals, man, like, don't even get me started. So what's
Yeah, I mean,
go ahead, Dave.
Technically, you're breaking a 2-month downtrend, and it's like you're coming up on the 50-day. If you break through the 50, I mean, it's something I would say, you just have to let it play out. The long term is in a downtrend until $50. If you're short it, do you want to wait until 50?
Yeah, I hear you. I hear you.
Full disclosure, I loved Coinbase last year because it has listed put options, and that's all I'll say. But no, look, and I wrote one of my Seeking Alpha articles on this recently. It was about the S&P 500, but it's the same damn pattern you see everywhere, George and Dave, and I see it with Coinbase here too. Yeah, climbing the wall of worry, etc. But you can go back to November, looks like, of 21, a couple months before everything hit the fan, and you've got a really, really hard, thick trend line, downward trend line, and that it has kind of been the juice that has allowed a lot of these things to bounce. And just when you think it's turning around and new bull market, etc., just like the S&P is getting close to right now, not too far away, all of a sudden, wham. Okay, whether it's the news, etc. So yeah, I mean, Coinbase is still sort of in that no man's land, where I mean, it could rally a chunk further, but again, we know how the math of loss works, right? I mean, when you're down a zillion% and you make 20 or 30% on a bounce, you didn't just turn $100 into something, you turned $20 into something, and it's a little bit less in real life.
Hey, one thing we haven't talked about, we've talked about the big investment banks, but, we haven't brought up like the Raymond James, Piper Jaffray, Houlihan, Lokey, Evercore absolutely look fantastic. I mean, across the board, Evercore's EVR, I mentioned on a call, Cantrell and I were on a call last night. We were going back and forth on a number of areas in the market. Didn't discuss these, but, Houlihan, Lokey, HLI, I think you're going to see a lot of M&A activity this year.
Right.
That's where I would be looking for, the next cycle to take place.
With you on EVR for sure. At least looking at the chart. Don't know too well.
Raymond James, RJF. I mean, it looks a lot better than, the banks themselves. So.
Got it. All right, so I'm gonna give Brent, if you're still, I don't know if you're.
Yeah, I'm here. I wanted to say one thing on Houlihan, which is they are restructuring, and they fix broken companies as well as doing M&A. So that's a big plus for them.
I mentioned that on a call last week, that investment banking and restructuring and Houlihan Lokey was the name I gave. So, yep.
There you go. All right, listen, Brent, I hope this has been fantastic. I hope you've enjoyed it as much as we have. We've learned a lot, and I hope you'll consider coming back to this room. If not as a speaker, just come in the room and be one of the elves and hang out. A lot of really smart people. We learn a lot from each other. And so I want to thank you, and as well as Charlie. I know Charlie's not here, but it was terrific. And again, I hope you'll consider coming back. If one is interested in learning more about Portalis and what Charlie and Brent do, please reach out to Brent through direct message, as well as you can email him. Brent, you want to give your email address, please?
BBE@PortalisPartnersLLC.com.
Great. And so this has been a great room, very timely. Be really curious to see how things play out. And so it's terrific. So I want to thank everyone. Thank you, Brent.
George, thank you very much. This is an amazing crowd you assembled, and we're grateful. Thank you.
Terrific.
Thanks.
All right. Good night, everyone. We'll be doing another room. I can't remember what our next one is, but we'll be together within the next couple of days. Good night, everyone. Take care. Bye-bye.